In this session of financial reporting, we are going to cover the standard IAS 2 inventories. Inventories are a very important part of every manufacturing organization because this is something which is definitely going to be recorded in their financial statements throughout the year and at the end of the reporting period as well. To begin with, we will see the relevant definitions of IAS 2. Inventories. What are inventories? Inventories are assets held for sale in ordinary course of business, in the process of production for such sale, or material or supplies to be consumed in the production process or in the rendering of services. Inventories, as you can see from this definition, step number 1 are assets. Which assets are those? The ones for which the intention of keeping them in the business is that we are ultimately going to sell them in the short term. So it is our regular or ordinary course of business in which we intend to sell them. So if we have a non-current asset which we want to sell, that will not be called our inventory. Inventories are items for which at the time of purchase or manufacturing, the intention was to sell them in the ordinary course of business. Naturally speaking, in our mind, finished goods generally come in when we talk about inventory. But finished goods are not the only items which become a part of our inventory. At the reporting date, if we have any items which are still in progress, work in progress. So for example, if I'm manufacturing a marker, I have made the outer covering, I have made the ink, but I'm yet to assemble those and I'm yet to put the sticker on it or the final cap on it. Then that is my work in progress. Such unfinished items are also a part of our inventory. Why? Because ultimately the intention for purchasing material for them or ultimately processing them or manufacturing them, with that the ultimate intention is to sell them. So all such items will become a part of our inventories. Any materials or supplies to be consumed in the production process. So the third type of items which may become part of our inventories are raw materials. So if we have any raw materials which in future are going to be used in the production process, they will also become a part of our inventories. So raw materials, work in progress, finished goods, in all of these, the ultimate intention is that these are going to be sold in the ordinary course of business. So such items are called inventories. Please do keep in mind that during the year, whenever we purchase an item, whether it is a finished good with the intention of resale or we buy raw materials, the double entry that we pass is debit purchases, credit cash, or trade payable. When we make the purchases, initially these purchases are recognized as expenses in our business. You know, we show expenses in our statement of profit or loss in cost of sales. What are those purchases? These are the items which have been purchased with the intention of resale. So during the year when we purchase the items, we immediately pass the double entry, debit purchases, credit cash, or credit trade payable if we have purchased on credit. At the end of the year, when we have to make our statement of financial position, we recognize the unsold purchases as our assets. Because you know, in statement of financial position, it is made as at the reporting date. So we have to show all the assets, liabilities and equity of that business on that particular date. So on that date, the purchases that are still unsold on our reporting date, they are recorded as assets and they are called inventories. Other than that, there are different ways in which inventories are valued internally. It can be on a period basis or it can be on a continuous basis that we are going to discuss later. So The first thing you need to understand is that when we talk about inventories, we're talking about all the items, whether they are in the form of raw materials, work in progress, or finished goods, that are still unsold at the year end, but the ultimate intention of buying them was to sell them in the ordinary course of business. The definition of net realizable value is here. I'm going to come back to it later on. The first question that arises is that when an organization makes inventory, they have to allocate a certain cost to that inventory item. Why is this important? Because every organization ultimately has to decide the selling price. It has to keep a track of its expenses. So all of these become a part of the cost of asset. So what we call the cost is the initial measurement of inventory. So for every item of inventory, we calculate the cost so that ultimately we are able to calculate the sale price, the profit, and overall evaluation of our business can be done accordingly. In this case, the cost or the initial value at which our inventory is calculated, that comprises of purchase cost and another item which is called our conversion cost. Just to understand conceptually, we are saying that cost of an item of inventory consists of two portions. One that we called purchase cost. If we purchase finished goods and then resell them, then the purchase cost will be our only cost of inventory. But if we are a manufacturing organization and we purchase raw materials and then we convert them into finished goods, then in addition to purchase cost, the conversion cost will also become a part of the cost of asset. So here, as we say, we will see what are the items that ultimately become a part of these purchase costs and conversion costs. Purchase cost comprises of the purchase price plus any import duties and other non-refundable taxes. Once again, all the expenses that are directly attributable. Any cost that is directly attributable to the acquisition of finished goods, materials, or services, that will become a part of the cost of asset. This word directly attributable is used in multiple standards. In all the standards, the meaning of this word is that any cost which would not have been incurred had we not made this purchase, that is called directly attributable expenditure. So anything which was directly related to the purchase of the asset, that will be included in the cost of this asset. A very common example in case of inventories also is carriage inwards. So any cost incurred to bring the inventory from the supplier to our own premises becomes a part of the purchase cost. Less any trade discounts, rebates, or any other discounts that are available, that will be subtracted from the purchase cost. Once we have the purchase cost, we move to the next type of cost that is included in the cost of inventory. This is called conversion cost. So costs directly related to the units of production, they are called conversion costs. Systematic allocation of fixed and variable overheads. The cost of conversion normally consists of two items. Number one, direct labor. And number two, production overheads. We call them production or manufacturing overheads. So the standard IS2 says that whatever cost you have to incur directly to convert the raw material into finished goods, that will also become a part of the cost of asset. So any direct labor, any production overheads will become part of the cost of assets. A common misconception is that the students, whenever they see the word overheads, they automatically assume that these are indirect expenses, although this is not true. Even the depreciation of plant or salary of a supervisor who is directly involved in the manufacturing process will be added to the cost of inventory. Why? Because they are manufacturing overheads. They are production overheads. So do not just see the word depreciation or salary and say they are not going to be part of cost of inventory. If they are directly related to the production process, they will definitely become a part of the cost of inventory. So when you have the purchase cost and the conversion cost, you add them both and this gives you the final cost of your inventory. Then we have certain costs which are specifically excluded from the cost of inventory. These are the items in which commonly a mistake is made thinking that these will also become a part of the cost of inventory, although they are not. Which are these costs? Normally these also come up in our exam. The examiner gives these to confuse you. What are the costs which are specifically excluded from the cost of inventory? Number one, the abnormal amount of wasted material, labor or other production cost. So any kind of abnormal loss will not become a part of the cost of asset. If there is a normal loss, that will become a part of cost of asset. A very common example of normal loss can be if you have sheets of paper and you're trying to make a diary out of it, which is round in shape, then naturally speaking, after cutting, some paper will be wasted. But then that is part of the normal production process. That is normal loss. Normal loss will become a part of the cost of asset. But what if we cut the paper wrongly or the paper was lying around and it got damaged somehow? Those kinds of losses are abnormal losses. They are not a part of our regular production process. Such costs are excluded from the cost of asset. Number two, storage costs unless necessary for production. Another way of saying the same thing is that storage costs during the production process will become a part of the cost of asset, but post-production storage costs will not become a part of the cost of asset. So if the requirement of our product is that we partially completed, then we have to leave it for 2 days, and then we need to leave it for 2 days on a certain temperature. Then we need to continue the manufacturing process. In such cases, the storage cost will become a part of your conversion cost. But once the product is complete and ready for sale, any further cost incurred on it will not become a part of your cost of asset. So for example, if a company is selling ice creams, it definitely needs to keep its finished good on a certain temperature, which requires storage costs. Any such costs will not become a part of the cost of sales or the direct cost of the inventory. They are costs of business, but they will be treated under different heads. Number three, administrative overheads that do not contribute to bringing inventories to their present location and condition. So any non-manufacturing or non-production overheads. And number four, the selling costs. Selling costs are not a part of the cost of asset, rather they become a part of our selling and distribution costs. Please keep these costs in mind. As I said, they very frequently appear in your exam to confuse you. In case of a service provider, normally students or when we go in the practical field, the confusion arises that would there be any cost of inventory in case of a service provider? So yes, cost of inventories for a service provider primarily includes the labor and other costs of the personnel directly engaged in providing the service, including supervisory personnel and directly attributable overheads. So in simple terms, for manufacturing organizations, the cost of inventory or ultimately the cost of sales that they charge to their P&L, that consists of material, labor and production overheads. In case of service providers, the cost of sales will only consist of direct labor and production overheads. Cost formulas, these are the accounting policies for valuing or recording inventory. IS2 has given only two choices to its users for valuing the inventory. They are FIFO, first in, first out, and weighted average cost method, which is also called average costing. First in, first out means that the inventory is recorded in a sequence and the record is kept, and it is assumed that whatever items were purchased first, they will be sold out first as well. Whereas in case of weighted average cost, at the time of every purchase, inventory value is calculated again overall. Now, all the items of inventory are at the same price and all of them are assumed to be ready for sale. No track is kept to show that whether the items purchased first were sold out or the later on ones were sold out. All inventory is considered to be at the similar stage. To calculate the weighted average cost, our formula is total value of inventory, no matter at how much price difference it has been calculated, divided by total number of units. So all the items of inventory come at one single price, which is considered to be then our cost of sales. LIFO method is no longer allowed to be used as per IAS 2. Now we come to the next measurement portion. In case of measurement, this can also be called subsequent measurement or measurement at the reporting date. As I mentioned earlier, during the year when we purchase the inventory, we record it as an expense under the name of purchases. But at the reporting date, we calculate the unsold purchases and then we recognize them as assets in our statement of financial position. In such cases, the subsequent measurement is done at lower of cost or NRV. This is very important. The logic behind subsequent measurement is a very important accounting concept which is called prudence concept. Prudence concept. Prudence concept says that it is an accounting concept and it says that your assets should not be overstated and your liabilities should not be understated. So this standard says that at every reporting date, complete valuation of inventory should be done to identify what is the cost of inventory. Then an estimate should be made of the selling price of that inventory also. The inventory should be recorded at the lower of the two. If the cost is 100 and the item is expected to be sold for 90, then the item should be recognized at 90 right away. But if the cost is 100 and the net realizable value is 110, then the item should still be recognized at cost. Why? Because the company has not yet earned profit on it. And any profit which has not yet been earned should not be recognized in our financial statements, and therefore the assets should not be overstated. So cost and NRV, these are the two items on which the comparison has to be made. Now, important thing over here is to identify what actually becomes a part of this cost and NRV. So when we say that the inventory should be recognized at lower of cost or net realizable value, what do we actually mean by these two items? With respect to cost, we have just covered cost is a sum of purchase cost plus conversion cost. Whereas net realizable value is calculated as estimated selling price less costs to complete less costs to sell. To understand the concept of net realizable value better, let me just take you back to the definition I skipped in the beginning. What actually is net realizable value? It is the estimated selling price less the estimated costs of completion, less the estimated cost necessary to make the sale. So please keep in mind, we are calculating the net realizable value for an item which is still unsold in our business at the reporting date. So we calculate an estimate as to what amount do we think is going to, are we going to get when we ultimately sell this item. So standing at the reporting date, a future estimation is made that when this item will be sold, maybe 1 month later, 2 months later, what is the amount that we will get against the selling of this item. This selling item value is called realizable value. But we have another very important word over here, which is net. Net means there is definitely going to be some deduction from this selling price, and the net amount that we are going to get is going to be our relevant figure. So here the standard says that first of all you estimate for what amount you will be able to sell your item. Then it says subtract the estimated cost of completion. In the very above definition, we discussed that inventories consist of finished goods, work in progress, and raw materials. So definitely speaking, at the reporting date, we have certain items of inventory which are still in progress, or some are available in the form of raw materials. Now the selling price that we calculate is of finished goods. So the standard says that you need to estimate the future costs also that you will have to incur to get these items, this work in progress and raw materials, into finished goods version. Only then this would be a like with like costing. So estimated selling price is calculated, estimated costs of completion are calculated, and if we have to make an expense to make the sale, for example paying an agent, etc., then that also should be deducted. This takes us to the net realizable figure. So for example, our estimated selling price was $100. The costs to complete incomplete products or unfinished products was $10, and estimated costs to sell were $5. So the standard says that the net amount that the company will actually get against this product is 85. This is how we calculate the net realizable value. Regarding this estimate that you have to make, the standard says that this should be the best available estimate at the reporting date. So you keep all the market factors in mind, inflation, competition, etc. Keeping everything in mind, this should be the best available estimate at the reporting date. So once you have calculated the net realizable value, all of this is happening at the reporting date. So at that point in time, you compare the cost of the item with its net realizable value, and whichever figure is lower, the inventory is recorded on that particular figure. Why all of this is being done? Because as we discussed earlier, as per prudence concept, assets or any kind of inventory should not be overstated. Now some general rules regarding the measurement of inventory. The write down of inventories takes place on an item by item basis. This is also called separate valuation concept. So the standard says that if you have different kinds of inventory, or you have more than one items of a single kind of inventory, then the writing down should be done on an item by item basis. So if I have 50 chairs in my business in my inventory at the reporting date, 5 might be damaged, 45 might be absolutely fine. So individually an assessment should be made of the situation and condition of the inventory, and then lower of cost or NRV rule should be applied on an individual basis as well. The NRV is based on the most reliable evidence available at the time of estimates made. Yes, definitely at the reporting date, NRV is always calculated at the reporting date. And as we just discussed, this should be the best available estimate at the reporting date. Once NRV is calculated, naturally speaking, our intention always is that we are going to sell the inventory within one accounting period. Our inventory figure consists of items which have been held for sale. So inevitably, our intention is to sell these in the short term. But if due to any reason the inventory is still unsold at the subsequent reporting date, then a reassessment is made of inventory at each reporting date. And on every reporting date, this comparison is made again of cost and NRV. Please keep this in mind when we say NRV is reassessed. The comparison once again is going to be made with the cost which was purchase price plus conversion cost. We are not saying that the comparison is made with the previous year's NRV. So at every reporting date, NRV is reassessed and this criteria of lower of cost or NRV is again applied. In case there is a reversal of write down. So in year 1, our cost of inventory was 100 and at the same date our NRV of this particular item was 95. In this case, the standard says that if we must have calculated or recorded the inventory at 95. But in the subsequent year, if the NRV of this item which was still unsold at the subsequent reporting date came out to be 102, then you have to reverse the write down that you have previously recognized. In such case, we reverse the loss that we had previously charged, but please keep in mind that the reversal of loss cannot be more than the initial loss charged. Here, initially the loss charged was $5. The inventory was brought down or written down from 100 to 95. So a $5 loss was indirectly charged in the financial statements. Later on, if the NRV becomes 102, the maximum reversal that can be done over here is of $5 only. Reversal maximum can be of $5 only. The value will come back to 100. It cannot go beyond 100. Why? Because as per rule, the inventory has to be recorded at lower of cost or NRV. Whenever a reversal of write down is made, you need to tell in the disclosures a complete explanation of why the reversal has taken place, why the write down was charged initially, and how much amount has been reversed. The same process is repeated at every reporting date. Now we will solve a question related to IAS 2 from our past exams. In December 2014, we got this question. It says that on 30th September 2014, Razor's closing inventory was counted and valued at its cost of 1 million. Some items of inventory which had cost to 10,000 had been damaged in flood on 15 September 2014 and are not expected to achieve their normal selling prices, which is calculated to achieve a gross profit margin of 30%. One thing at a time. Let me highlight the key figures for you. Reporting date is 30th September 2014. Closing inventory was counted and valued at its cost. Please keep this in mind. This value of 1 million consists of all the items at their cost. So far, the comparison of cost and NRV has not been made, so all items have been recorded at cost. some items of inventory which had cost of 210. So naturally they were included in the 1 million figure at this cost to 10,000. So this inventory has now been damaged due to flood, and it is not expected to achieve normal selling price, which is normally calculated by charging a gross profit margin of 30%. Just a quick revision of the facts. The total cost of inventory is 1 million. Included in this figure is a problematic item which has a cost of 10,000. Normally speaking, these items are sold at 30% margin. But due to flood, which happened before the reporting date, these items have been damaged. Now the sale of these goods will be handled by an agent who sells them at 80% of the normal selling price. Normal selling price would have been 10,000 with 30%, 10,000 with 30% gross profit margin. The sale of these goods will be handled by an agent who will sell them at 80% of their normal selling price and charges Razor a commission of 25%. So not only is the selling price going to be lower, even to sell these items at a lower selling price, we need to pay a commission of 25%. Now let's see the question first. At what value will the closing inventory of Razor be reported in its statement of financial position as at 30th September 2014? Please keep this in mind. The examiner is asking you the total value of inventory, not just of the problematic items. So what we need to do over here is, we have the total cost of inventory, which is 1 million. So if I do the working in dollar thousands, so this inventory, if I do the working in dollar thousands, the total cost of inventory is 1,000. Now I have to do an analysis of lower of cost or NRV for the problematic item. The problematic item has a cost of 210 and I need to calculate its NRV. I will calculate the NRV separately. Step number 1, we need to have the estimated selling price. Here we can see the question says that 210 is the cost and 30% is the gross profit margin. So if I divide 210 by 0.7 or 70%, we get the estimated selling price of 300,000. Keeping dollar thousands combined, the selling price is going to be 300. Whenever such questions come in which you have to calculate gross profit margin or markup, you can use whichever approach is suitable for you. A foolproof method is that you write the complete equation: sale is equal to cost of sales plus profit. You can put in the cost, you can put in the profit. If the sale is X, the profit is 0.3X. You can rearrange this figure. 0.3X is equal to 210. So X is now going to be 210 divided by 0.7. And this is going to be our selling price of 300. So if you are proficient in using the shortcut method, that is fine. Otherwise, do not take the risk. Spend maybe just 30 seconds extra. But this method is a foolproof way of getting the correct answer. So now you have your estimated selling price of 300,000. But please keep in mind, this is not your actual estimated selling price. Why? Because the question says that at 30% it is sold under normal circumstances. Our expectation is that the item is going to be sold at only 80% of the actual selling price. So we have to recalculate our estimated selling price. Estimated selling price is 300 into 80%. This figure comes out to be 240. So our estimated selling price is 240. On this, the agent is going to charge a selling cost. The selling cost of this item is 25%, the commission that the agent is going to charge. This commission comes out to be 60. So the NRV of these particular items is going to be 180. Now you apply the rule of lower of cost or NRV. So the cost of the item is 210 and the NRV is 180. As per the lower of rule, the figure of 180 should be used. Already the item has been included in this cost at 210. So what we need to do over here is we should remove the item at its cost and add it back on its NRV. This will give us the final figure of our answer, which is 970,000. This is a longer method. If you can directly calculate the difference between the two, then the difference between 210 and 180 comes out to be 30,000. Inventory is overstated by 30,000. So you can simply say 1000 minus 30 and the value of my inventory is going to be 970,000. So once again, whichever method you are comfortable with, you go and do the working accordingly. One last item related to inventories. Just a quick revision. The cost of sales formula is opening inventory plus purchases minus purchase returns plus carriage inwards less closing inventory. So opening inventory plus purchases minus purchase returns plus carriage inwards minus closing inventory. 2-3 important points that I wanted to discuss before we finish our lecture is that such kind of equation can be used in the question where examiner says that there was a delay in calculation of inventory. So you need to apply this formula in those cases as well. Always keep in mind this closing and opening inventory needs to be calculated as per the rule we have just discussed. Since these are both used in the calculation of cost of sales, at times their relation with profit may also be tested. So the higher the closing inventory, the lower is the cost of sales as per this formula, and the higher will be your profit. Similarly, vice versa, if lower the value of closing inventory, higher will be the cost of sales and lower will be your gross profit. Another point that you have to keep in mind with respect to your final accounts questions. In final accounts questions, normally in our exam, a trial balance is given and certain adjustments are provided. If the trial balance gives you the opening balance of inventory, then definitely in your adjustments you can find some information regarding your closing inventory. Once again, using the above formula of cost of sales, you can reach your final figure. If your trial balance already has given you your closing inventory, then definitely speaking, the trial balance will also include a figure of cost of sales. That cost of sales figure you can use in your P&L. The closing inventory is going to be used in your statement of financial position. The double entry for your closing inventory is you debit the closing inventory in statement of financial position and you credit the closing inventory in P&L. Some people write another version of this inventory which is also correct. So they say debit inventory and credit is to cost of sales, as you can see over here also. So closing inventory always decreases the cost of sales. So there can be a debit to inventory, which is asset, increase in asset, and credit to cost of sales, which is a decrease in expense. This is all with our lecture on inventories. Please go through this lecture and through the notes that you have for inventory and attempt all the relevant past exam questions to become proficient in this topic. Thank you.